please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back to this special. We are coming to you from the sidelines of the JPMorgan India Investor Summit 2018. Well, let's move to the next view, and this one comes from Filippo Gori, who is Head of Markets and Investor Services of the entire Asia Pacific region at JPMorgan. I started off by asking Filippo just how serious and significant this de-rating of emerging markets is and whether we're anywhere close to a bottom. Filippo tells us that all is not lost for a market like India, but the next couple of weeks and months perhaps could be slightly challenging.
My feeling on the trade war is it's a lose-lose situation for both countries involved. Whether it's going to spiral out of control and therefore create a sort of a bigger problem for the overall emerging markets asset class, I think it's too early to call. I still have an optimist view that the trade war will be somehow resolved. If anything, India should benefit, could be benefiting from a trade war, because it should remain to a certain extent immune from that pain. While 2017 was the year where you had a global growth coming from all the countries, this year I would say is more of the year of the decoupling. The US economy is still going on very strongly, and we expect further hikes this year. Europe and my own country is having different sort of problems, and in EM you start seeing kind of a two-tier environment where the current account deficit countries are suffering, while those who have a surplus are probably faring better than the others. Whether overall it's the end of the capitulation of the EM trade, I think it's just too early to call it. Our view is that the currency will remain around 72, probably in up to June of next year. I mean, we feel that there are probably two hikes coming from RBI, one in October, one in December, and possibly we think that the government will defend the currency strongly even inter-meetings. The economic fundamentals of India remains super strong. I mean, the last quarter was the best quarter that India's had, with an outstanding growth of 8.2, 8.3%. It was the best quarter of the past 9 quarters, and our forecast for next year is still that India will grow at a 7.3% GDP growth, which would put India as the fastest growing economy in the world. So the economic fundamentals, the demographics, the tech sector, the healthcare sector are still doing superbly well in the country. The country has a current account deficit. 3% of GDP is being watched by foreign investors. Next year is an election year, and therefore investors will be looking at carefully for fiscal profligacy, and what investors will want to see is some sort of fiscal orthodoxy. I mean, a certain way of behavior by the government that will protect the currency, and therefore I think we are not looking at a doomsday scenario.
All is not lost in India for sure, and we are not looking at a very, very difficult situation. Nonetheless, there could be risk aversion that continues, which means that India as a market could face some near-term headwinds. And that is a sentiment that was also echoed by Sunil Garg, who is the head of international equity research at JPMorgan. He too said that emerging markets could face a couple of more hiccups, and India could see some testing times ahead.
It's been a pretty rocky last few months for emerging markets. In fact, I think emerging markets since the peak in February are down nearly a quarter, and currency is playing a big role. It clearly is some cause for concern, because you know, we've lowered our estimates in terms of target price for MSCI Emerging Market Index, and also some of the EPS numbers. But the fact remains that emerging markets are very cheap, and in fact they're trading at a much wider discount to historical averages, and that at least provides a value floor in emerging markets. So overall we are positive. I think the big driver here, it's going to be China, because China has been a massive underperformer. So it's not just some of the Latin American currencies that have been weak, but it's China's equity market that has been dragging down EM performance.
You said you've lowered your MSCI Emerging Market Index target. How much have you lowered it to? And what's your view on MSCI India? How do you see it shape up over the next, say, 6 to 12 months?
So our MSCI Emerging Market Index, we've lowered it by about 8%. So 1130 is our target versus where we were about 1230 earlier. We do have some reason for caution. First of all, we've had a very strong performance from here. I think in terms of where our Nifty targets are, it's probably a relatively modest upside at this point in time. And we think the consensus earnings estimates are probably a bit too rich. They're about somewhere between 21 and 25% for either MSCI India or Nifty, and we think it's going to be closer to 15%.
For Indian market, there's been two legs of a big bull market. There's consumption and the companies that finance that consumption, and both have seen quite a bit of correction over the last few weeks. You reckon they could correct more from here?
So look, I think financials are still not a very attractive sector in the Indian market at the moment. In fact, I think financials have struggled pretty much everywhere globally, even in developed markets, and that's not one of our preferred sectors. I think there's probably interesting opportunities in sectors like healthcare. Now, that may not necessarily be a domestic consumption story, but that's also been a very large underperformer if you take a one-year context, and I think that looks like one of the better opportunities at the moment.
Okay. Sunil, more particularly in India, we have seen a very sharp rise in bond yields to about 8.2%, the Indian 10-year, at least 50 basis points higher than what it was a month ago. How much worse does the cost of capital get, and will that add fresh reverses to the financial sector?
We actually think that higher bond yields are a sign of confidence, and typically, historically, and particularly in developed markets, they've been associated with better equity markets rather than the other way around. So in some senses, we are seeing a interest raising cycle pretty much everywhere. Yes, it does raise the cost of capital, but if it is accompanied with a better growth outlook, then I think that's net-net a better outcome.
What about flows, Sunil? In your interaction with foreign investors, how is the mood with respect to investing into India now, especially considering the way the rupee has moved? Would you expect more redemptions from FIIs?
Overall, emerging market positioning at the moment is light. And I think India is, as I again mentioned earlier, has been one of the stronger outperformers. So, there's clearly a possibility that as investors get more comfortable with emerging markets, it rotates into markets that have massively underperformed, and that would be places like China and some of the CEMEA and the Latin American markets.
There have been a lot of downgrades that we've seen in India of late, and in fact the FII holdings into India is also down from an all-time high. JPMorgan is still relatively bullish. Why is that?
Our index target has about 7–8% upside. Now, is that ultra bullish over a 9-month period? I think it's not a bearish view, but I think the markets got a bit of a, I would say, volatile time ahead. I think you've also got an election year which poses some headwinds. So I think relative to other emerging markets, there are headwinds that we're seeing here. We're not bearish on India, but I think the index, having delivered such strong performance at the aggregate level, is probably going to struggle a bit from here.